So we can begin the question number 25 that says that Mr. Alex Mawezi, an audit client, has been trading for several years. He has provided with you the following list of accounts balances as at that 1st of December 2022. So we are given all this. Then we are told, as you begin the audit process, you discover the following adjustments that should be made to finalize the financial statements as you carry out the substantive tests. Closing inventory, insurance prepaid, heating and lighting accrued, prepaid rates, ADR expected credit loss is estimated as okay, I can see concerns that I have skipped question 24. Okay, because I have already read, let's just proceed, not a problem. Then we will come back to question number 24 in our next lesson. Question number 23, those who are wondering whether it was completed, yes, we did. Because the few items that remained, I gave you the notes. I sent you the notes in the WhatsApp group of how you're supposed to finish. So that question is complete. But question number 24, because I have forgotten, we will look at it in our next lesson. Let's just proceed with the one I've read. Okay. So we have errors and omissions identified. An invoice for goods sold was not posted. Drawings of goods not reflected in drawings. An additional credit loss omitted. Depreciation expense for the year is understated. Required, prepare an audit schedule for 8 columns with the following headings: the original top balance without adjustments, the adjustments, the draft profit and loss items, the draft statement of financial position. Each section should have debit and credit columns duly balanced. Good. So with that, we come here and make the solution. We will have the details here. We require to have 8 columns. We require to have 8 columns because of these 4 items. So first of all, let me adjust this column. This column for B, I remove the decimals. Come home here. Move the decimals that way. Then I can reduce the figure, the width. That way. Now I need 8 of this. So let me first of all reduce this mpaka hapa. Then I reduce this. I need 8. We need 8 of them. We need 8. So let's do the adjustments quickly. So these two, you merge. These two, you merge. These others two you merge, and these others two you merge. So this one is original trial balance. Trial balance. Haya, hii ingine ni adjustments. Hii ingine, let me call it income statement. Na hii ingine ni statement of financial position. I don't know whether this one I can do the text wrap. Where is text wrap? This one. Even this one. Even this one. Put them up there. Put them both. So this is debit. Credit. Copy, paste. So I believe you are done with that. So if you are done with that, what you do now Let's first of all take this one, copy this one, and bring it here. That way. If you want to put borders, you can put. But before then, let's come here, take these items, these ones. You copy them this way up to here. Copy. Come and paste there. Then these figures, you also copy them. You also copy them. Then you paste here. You paste them here. So once you get there, say my yes. Once you get there, and you have something like that, for the audit schedule, say my yes. Those who are not yet there, ukifika hapo sema yes. Sema yes, sema yes. I'm waiting. 5 people have said yes. The others? Mhm. Two more people. So I think now we have to proceed. Now, what you do from there now is just to tell us or just to know where each item belongs, and you put it accordingly. You put it accordingly. Just a minute. Capital. Is it debit or credit? Capital, debit or credit? Hey, good people. You are almost to qualify to be very senior accountants. Capital is credit, so you delete that. Revenue, debit or credit? Hmm? Yeah, credit. Trade payables, debit or credit? Credit, good. Returns outwards. Payables are credits. They are liabilities. Higher return outwards. They are debits or credits. Returns outwards. Hey, you people, you don't work in auditing companies or audit your books. Hmm? Return outwards is a credit because it serves to reduce the purchases. And purchase is an expense which is debited. So these are credit. Expected credit loss is debit or credit. Hmm? Yeah. Expected credit loss, where does it belong? Hmm? Good people. Financial accounting. Expected credit loss is a credit because this represents amounts that our customers have failed to pay us, and therefore it serves to reduce the receivables. So if it reduces the receivables, it is a credit balance. So this one I can wrap it. Discounts allowed, those are expenses, and expenses are debited. So that's a debit balance. Discounts received is an income, and incomes have credit balances. Purchases is an expense, and expenses are debited. You could also look at it as an asset, and assets are also debited. Returns inwards. Return inwards. It occurs when we sell goods and customers return them. So they reduce our sales. So they are supposed to be debited. Or in other words, they increase our assets. So we are supposed to debit. Distribution costs, that is an expense. And expenses are debited. Drawings. Drawings reduce capital. They reduce capital, and therefore they should be debited. Rates, insurance, and rent, those are expenses. They should be debited. Heating and writing as well should be debited. Postage, stationery, and telephone. This one should also be debited. Advertising, we also need to debit. Salaries and wages, we also need to debit. That's an expense. Credit loss is an expense. The bad debts, we need to debit, is an expense. Cash in hand. Cash in hand is a current asset. And as a current asset, it needs to be debited. Cash at bank is also a current asset that we need to debit. Inventory is at 1st of January. That is also an asset. We need to debit that. Trade receivables. Those are guys we have sold to on credit. And that is an asset. We need to debit. Property, equipment, and furniture at cost. That's a fixed asset. You debit. Accumulated depreciation is that 1st of December. Accumulated depreciation serves to reduce the costs of the asset. And if it serves to reduce the costs, it is always negative, so it's credited. And depreciation expense for the year, that's an expense that should be debited. Yeah. So that is how you prove that you know one of the basic things in financial reporting or financial accounting, preparation of a trial balance. Preparation of a trial balance. My good friends. Preparation of a trial balance. Any question? Let's come here and see whether it will balance. You say equals sum. You pick from here. You add all the way up to here. Press enter and give me the total. Professor. Give me the total. Yeah, good. So this one, if you just drag, perfect. Can see it's balancing. It's balancing. So sasa, this one we don't need it. We first of all delete because there may be additional items that will come in. So we are done with that. So what we need to do now from there is to respond to the additional information. Here. As you begin the audit process, you discover the following adjustments that should be made to finalize the financial statements as you carry out the substantive tests. The closing inventory is this much. Now, if you remember how we prepare the income statement, closing inventory inakuanga pale chini where we subtract it. And it is also part of the current assets. It's part of what goes to the statement of financial position as a current asset. So because it is not mentioned anywhere in these items, we shall come here and talk of the closing inventory. Now, this closing inventory, we have two types. We have said there is one that will go to the income statement. The one that will go to the income statement, the one that will go to the income statement will be debited. Then, sorry, will be credited because it's near to subtract. Then we have the other one, the closing inventory. Sorry. The closing inventory that will go to the statement of financial position. The statement of financial position. So this one that will go to the statement of financial position, we will debit it. And how much is it? It is 80, I will say equals, then I pick this amount, this one, and I put it there as a debit. Then whatever is going to go to the income statement is a credit, equals this one. So those are the adjustments. Now these ones, we must now post them where they belong. This one we are saying it is going to go to the income statement, debit here. We take it there. When we take it there, this one is going to go to the statement of financial position as a current asset. So we debit it. We debit it there. So those are the transactions that pertains to the closing inventory. Haya, ukipata swali unauliza. Let's go to the next item. The next item that has been mentioned is insurance prepaid. When you have a prepayment, that is a current asset. It means you have paid for something you have not yet used. So what we need to do is to go and reduce the insurance by this amount. So we credit that. And then we debit the prepayment so that it becomes a current asset. Now, when we come to our books here, or to our statement, we find that insurance is a composite or is an ingredient. They are combined. The examiner here has combined rent, rates, insurance. So we do not know exactly how much of this 12 million is insurance. So what we do then, we just create different lines for them. And one will go to the income statement to reduce this expense. And the other one will go to the statement of financial position as a current asset. So I can just copy this one here. I bring it here. Then kwanza nikuje hapa niitoe hapa hii niseme prepaid insurance. Prepaid insurance. I come and copy this other one. And I paste it here. And I also say the same. Prepaid insurance. So there is that which will go to the statement of financial position as a current asset, and which is going to the one which is going to the income statement as a reduction of the cost. So in the financial statements, because we are going there as an asset, we debit here. So I say equals, nikibia hapo juu, I take that amount. This one. Then I credit here the one that will go to the income statement. I credit. So under the adjustments, I'm debiting because of what will go to the financial statement, statement of financial position, and I'm crediting because of what will go to the income statement. So I come and complete the cycle here by crediting the income statement, the column G. So I credit that one. And then I come debit my statement of financial position. I go for the next one. Heating and lighting accrued. So an accrual is a liability. It means an expense we have incurred or we have spent, but we have not paid for it. So how we treat it is we debit that expense so that tunaongeza, and then we credit the accruals to show as a current liability. So to do that, I will again come look for that heating and lighting. At least this one is here on its own. I can choose now to come and credit here. And then create the entry on its own that will go to the income statement. I mean, to the statement of financial position. Either way can work. So what I will do, I will just come here, I copy this, I paste it here. Your statement of financial position. So I say here, accrued heating and lighting. Accrued heating and lighting. So the accrued heating and lighting here, it's going to go to the credit because it's a liability. So say equals, I go for this amount. That one. I press enter. And because it's a liability, I can come and complete the cycle here. Equals this one. I can come and complete the cycle there. Then this one that I have credited, I need to come and debit it in the heating and lighting. This one. I need to come and debit here. This is where my debit for the adjustment is. Equals, I come and take this amount. When I take that amount, I need to complete this. This is an expense. And I've said what will happen is that this expense will be added. So when I come here, Yes, Nyabura, I've said we will debit the heating and writing here. This one. Because we are increasing it. Since we already have used, what we have not done is to pay. Then we come and credit here. This one is a credit in column E. Yeah, because is an accrual, a current liability. So ninaionyesha hapa. And why I am debiting here is because I need to increase this. From this 5, I add this so that I get the correct amount here. So is that okay, Nyambura? Good. So I come here and I say equals this 55 plus this. Okay. We are good there. Let's go for the next one. The next one is prepaid rates. So prepaid rates will just be treated like we did with this insurance prepaid. And you can see they are together here. Here. So what I will do, nitakuja hapa. There is that which will go to income statement. So I copy this one. I come and paste it there. Then I say this is prepaid rates. That's going to go to the income statement. And then I copy this one. So the same way we have explained that this prepayment is an asset. So we are supposed to debit the statement of financial position here. So we debit here. So I go for it. This one. And then because it's an asset, I come and debit it here. I come and debit it here in the statement of financial position. So I debit here in the adjustment and I debit it here in the statement of financial position because it is a current asset. Then because there must be a corresponding entry, this being debit, the credit now will go to the income statement, this one here. So say equals this one. That's where the credit will be. And it will also be a credit here in the income statement. It will also be a credit. It will also be a credit there. Oh, speed imeongezeka sana. Okay, sawa. Good. Najua now when I'm not asking figures, the challenge to gauge the speed. So Ruse, are you now where I am? If you are where I am, sema yes. If kuna mahali hujaelewa, let me know. Bado, okay. Tembea tu polepole. Unifikie. Whatever you have missed, let me know. Let me do something as you catch up. Once you get there, let me know. Prepaid rates on income statement, we are crediting. We are crediting because it's supposed to be a negative. It's supposed to reduce the amount. Yeah. So we are crediting it here. Otherwise, we should have come and credited it here to get credit hapa kwa hizi. But now that we do not know how much of this, because this is a combined figure, that's why we are giving it independently. But kama ikikuwa peke yake kama hii, tungeiweka hapa. Is that fine? Good. Karibu. Haya, so let's proceed on to the next item. The next item is end of year expected credit loss. So the end of year, what that tells you is this. When you come here, naona hii, this expected credit loss. At the end of the year here, when you come to close the financial statement of financial position, the amount, so sema equals, the amount is supposed to be this one. Yeah, when you come to close the year, the amount is supposed to be this one. Now, if it's supposed to be that one, you now need to compare it. You now need to compare it with what we already have. What we already have is 12. So what has happened? Has it increased or decreased? What has happened? Yeah, it has increased. Now, an increase in credit loss is always debited, is an expense, is an expense. Inamaanisha our receivables are coming down. So, if it is debited, we shall debit it here. We shall debit it here. Sorry, we shall credit here to show we shall credit here to show this increase. Then we debit it as an expense on its own, because I've said an increase is always debited. So because this one is supposed to serve to reduce the receivables, let's first of all get that increase. The increase now should be this 1865 minus this. Give me the answer. The increase in that give me that answer. Yeah. So that now, this 1256, if you add to this, it should bring you this. And I've said there's an increase in credit loss. Actually, there are two ways of dealing with this. Nilikuwa nimeona kama tuko na credit loss somewhere on its own. This one. You see this one? You can now come and debit it here. This one. Or you can give it as an independent line here. You say increase in credit loss. Either way can work. Either way can work. Either way can work. So I will just come here where we have the credit loss. To be fair to the user of our statements, ndio ajue hiyo 609 imetoka wapi. Let's give it an independent statement here, an independent line. We call it increase in credit loss. And this increase in credit loss, it is supposed to go to the income statement. It's supposed to go to the income statement because it is an expense. So instead of debiting here, if I chose this one yenye nilikuwa nimeonyesha earlier here, if I debited here, I would have now added to this, ndio nizilete hapa kwa debit. But now that I'm not doing that, I will come and debit here. Equals this 609, I bring it there. I take it there. And then I come and put it here. I debit it in the income statement. The next item errors and omissions. identified. Number one, there was an invoice for goods sold not posted. So we sold goods, we never posted. So the effect of this, the effect of that is that our sales are understated. And even our receivables are understated. Because anytime you see an invoice is issued when we are doing credit sales. Invoice is issued when we are doing credit sales. So, we are going to increase our sales by crediting them and increase our receivables by debiting them. So let's go to where our sales are, these ones. So sales being credit, if you want to increase them, you credit. So I will start by crediting here. I credit by this amount. I credit by that amount. I credit by that amount. Then I come and bring them to the income statement, the new sales. The new sales will be this 129 plus this one. The new sales. So get that as I take 1 or 2 minutes to mark the register. I hope you have gotten that figure as that. Then, if that is what you have gotten, if that is the figure you have gotten, this amount, I had said we are going to use it to increase our receivables. So let's go to where our receivables are. Receivables, trade receivables, nilikuwa nimeziona wapi? Yes, ndio hizi. So these ones, for us to increase them, we need to debit. So we debit equals by this amount, this one. So we debit the receivables, and then this amount needs to go to the statement of financial position. It needs to come here. So you say equals this plus this. So those are our receivables. Higher. The next thing you do is drawings of goods not reflected in drawings. So for these drawings, I had said drawings serve to reduce the purchases. So we shall credit purchases, because that's where they were gotten from, and debit the drawings. So let me see whether we have purchase deal here. So we first of all credit the purchases equals these drawings. It's supposed to reduce the purchases. And remember, purchases will be on the debit side of the income statement. So we bring it here and say equals these purchases plus this one. Not plus, it's minus. It's minus. Because you have credited, it's a minus. So we have that amount. Haya, sasa we now come and debit this in the drawings. Drawings dear huyu. So we increase the drawings by that amount. And that drawings, we take it now to the debit of the financial position. Now, this one does not go to the income statement. Drawings do not go to the income statement because they serve to reduce capital. Drawings reduce capital. So you're supposed to debit them so that eventually they will be used to reduce capital, which is a credit balance. So we say equals these initial drawings plus this one. So give me that amount. Give me that answer. Yes. Yeah, that's the amount. Higher. The next one is an additional credit loss omitted. So we have another one. So this one that was omitted, it is supposed to come and increase. It is supposed to come and increase this credit loss. You see this one? We are supposed to increase it. So we debit here. We increase it by this amount, 220. We increase it by that amount. And when we increase it, we take it now to the income statement as a debit. The new amount should go to the income statement as this 1,004,000 plus this one. So tell me the answer. Yes, that's the amount. Then this one, because it will come to reduce the receivables, the receivables. We can either create an independent line or come and bring it where we had the receivables. You see these receivables, this one. We could come and bring it here. So instead of creating an independent line, we can bring it here. We bring it here equals this one. Now, when we bring it here, we have to revise this one. We have to revise this one. We have to revise this one. Now, this one was given as this, the original, plus this one that had been omitted, the sales, minus this one. So give me the new figure, the new receivables. Yes, 14,670. So you can bring it there, ama unaicreatea its own line. Whichever way, bora, where you put it, ikue on the credit. Higher. The next one is this one. Depreciation expense is understated. So when we understate, we are supposed to go and add the depreciation. So let's go to where there is depreciation for the year. This one. So this one is understated. So to add it, we will debit. To add, we shall debit. So we come here and say equals. We debit this amount. We debit this amount. And the depreciation for the year is an expense. Is an expense. So we need to debit it in the income statement. So we will take this original plus what we have increased. The original plus that. So give me the answer. Give me the answer. Good. Then this increase, this one, it should also serve to increase the accumulated depreciation. The accumulated depreciation should be credited. So we come here, we credit this. We come and credit this. Then this one, we bring it here to the end of the statement, where we shall say equals this plus this. So add the two and tell me the answer. Yes. So I think we have done justice to the additional information, all of them, all this. We have responded. If you are okay at that point, say my yes. If you have any query, raise it. If you are okay up to that point, say my yes. Yes, Nyambura. Yes, Rose, Lucy, Sharon, James, David. Hi, I think we are good. Now, once you're done with the additional information, what you do next now is to complete these items. For the capital, it has not had an adjustment. So that means it should come here to the end, the way it was at the beginning. So this one, you bring it there. Revenue, that one we have had an adjustment here. We already have reacted and put it where it belongs. Trade payables, no adjustment. So we bring it where it belongs. Credit is a credit balance. Is a credit balance. Returns outwards. Returns outwards. No adjustment. So they belong to the credit of statement of financial position. Expected credit loss, we had an adjustment and we took it where it belongs. Discounts allowed. That's an expense, no adjustment. So let's bring it where it should be. It belongs to the income statement debit. Similarly, discounts received, no adjustments. It belongs to the income statement credit. Purchases. They had an adjustment and we put them where they belonged. Returns inwards. They serve to reduce the sales. No adjustments. So we debit them here. They should be on the opposite side of sales. These sales here. So they should be on the opposite. Sorry, I think I made a mistake. This return outwards should be on the opposite side of sales. So let's rectify this, or sorry, opposite side of purchases. The returns outwards. So we are supposed to drop it. It should appear here. So rectify that. The return outwards should be opposite of the purchases. This one. That way. You don't go to the balance sheet. Higher. Distribution costs, that is an expense, no adjustment. So we bring it to the income statement here. Drawings, we adjusted and put them to the final price. Rate, no adjustment. So we bring them to the debit. Heating and writing, we adjusted and took them there. Postage, no adjustment. So this is an expense. We bring it here. The same with advertising. We bring it here. The same with salaries. So those three I'll put there in the income statement. Now credit loss, we adjusted. So that is okay. Cash in hand is a current asset that should be brought here. We debit. The same should happen with the cash at bank. Cash at bank is also a current asset. Now beginning inventory, that is the opening inventory. Huwa tunaiweka kwa pamoja na cost of sales, or in getting cost of sales, it's supposed to be debited. So this one we should debit. Because remember we credited the closing. So we need to debit this. Receivables, we adjusted to the end. Plant, property, and whatever, no adjustment, but we know is a fixed asset, should be here. It should be on the debit of the statement of financial position. Accumulated depreciation, adjusted accordingly. Depreciation for the year, adjusted. Then from here, these are the ones that we have created by ourselves. And you remember we were completing the full cycle. We were completing the full cycle. So what you do at that point, after now you have filled the additional information, then you have treated each item appropriately. You have treated or posted each item appropriately. You now come to close your books, and this is done by now looking for profit for the year. Profit for the year. So that after that now we shall have the totals. So profit for the year, maybe what we need to do first ni kukuja hapa kwa, naona huyu income statement, this one. We get the totals of the two sides. Ndio tujue whether there is a profit or loss. So I can just come somewhere here, wherever I say equals to the sum of. Nianze kuchukua hizi vitu ziko kwa, nichukue kuanzia hapa, nipande nazo mpaka hapo. Close the brackets, press enter and give me the answer. And 135. 135. I mean, niko na 137. Someone else? 137. So James, angalia ni gani huna? Yes. So we are agreeing is 137. So you see now on this side, this is 152. So do we have a profit or a loss? Is this a profit or a loss? Is this a profit or a loss? Yeah, it's a profit. So James, hakikisha uko na these items. Especially hizi ziko na 2 million. Hizi returns inwards, the distribution. Gani ingine iko na 2 million? Hizo bili. Hebu angalia whether you have the two. James, most likely one of these two. So good. If you have identified, then that's good. So let's now come and compute the profit for the year. And this is how you go about it. So right near profit ni hapa. So itakuwa hapa. So utasema equals sum. You take the sum of the credits. These ones. These ones. Going upwards. Paka hapo. You close the brackets. Then you say minus the sum. You minus sum. You double click here. Then unateremuka na hizi za debits. Debits. Paka hapo. Close the brackets. Press enter, tell me the profit figure. Give me the profit. Only one person is giving the profit. Yeah, so we agree with 14,311. So this one I can do away with them. So nikuje sasa hapa, nitakuja hapa, nitafute total. In the original trial balance, niseme equals the sum. So I'm summing from here upwards up to there. I close the bracket. This one we had gotten it. We had gotten this. So I just now come here, give it a double bottom and bold. Then I run with it up to there. Then this profit, these profits, we need to credit it here. We need to credit it here. And in so doing now, our books are balancing. So if you have any query, you can raise it. If you are okay, say my yes. So are we okay? Are we okay? Today you are very quiet. So then we call it a lesson at that point. We shall pick up from there in our next lesson. Thank you very much and good night.